Now joining us for another Mangru one-on-one from Malvern, Pennsylvania, is the creator of the world's first index mutual fund and the founder of the Vanguard Group, John Bogle. Jack, it's an honor to have you on the show today.
It's good to be with you, Dan, always.
I want to start off talking about Goldman Sachs, and they seem to be the poster child for irresponsibility on Wall Street. I mean, these guys were practically laughing as their firm made huge profits and their investors lost billions. So have we seen the worst of that me-first mentality on Wall Street, or is the worst still yet to come?
Well, first of all, the Goldman case is an interesting case about whether there's actually been a criminal act taking place, whether it's a prosecutable crime, and we don't really know that. It's certainly the testimony and all the evidence that's been put in certainly suggests that there's something close to unethical going on here, and that's probably quite enough in this business. Unethical is not the way it should be. We should be stewards of our clients' assets and money. So, but it's not as if there aren't two sides to every trade. You know, Goldman found Mr. Paulson, I guess, who wanted to be short these collateralized debt obligations, but someone else wanted to be long. It's an indication that the Wall Street is really just a giant gambling casino in many, many respects, too many respects. And those who bet long and those who bet short, those who bet up, those who bet down, offset each other, except it's not a zero-sum trade because that croupier in the middle, we call it Wall Street or we call it Las Vegas, takes too much of the proceeds of that transaction.
Jack, you're an old school guy, and you've built your business from the ground up. Do you believe in the financial services industry that brokers and advisors should only make money when their clients make money?
No, I don't believe that because the nature of the stock market, taking the simple extension, is stock markets produce a lot of money, and that's how the clients make or lose money in the short term. And it goes in spurts. And for example, we had two fabulous decades in the 80s and 90s. One of the worst decades in history in the first decade of the 2000s, and we're probably set for more or less an average decade. If we'd been paying on the basis of how much the clients had made in the abstract, our advisors would have been greatly overpaid, as mutual fund managers, by the way, obviously were during the 80s and 90s, and gotten no money at all in the 2000s, maybe when they were needed most. So, you know, maybe if you could average it out over a decade-long periods, you'd make some sense out of that, but I basically don't think so. I think you should be paid probably on an hourly basis for professional services like lawyers are paid or more or less like doctors are paid.
Coming down the pipe in Congress is the new financial reform bill. Do you think that this properly addresses the problems on Wall Street, or is this just election year politics?
Well, I think it's a legitimate and honest attempt, intellectually sound attempt to deal with the problems, even as we all know that there'll be new problems that this legislation won't deal with. That's what Wall Street is like. There's always, you know, it's like water going through the rocks. There's something that always escapes as times change. So some of the legislation is, particularly the financial legislation now before the Senate, is really good stuff. Getting derivatives on an exchange registered so we know prices and volumes will make less money for the croupiers, Wall Street, and therefore have the buyers and sellers do better.
Now, a big problem that the financial reform bill has is that many people perceive that we're institutionalizing bailouts and giving license to Wall Street's biggest banks to take on excessive risk. Now, is this just a case of misconception, or is this really happening?
Well, the bill is kind of a funny one. There is a bailout, but we usually think of bailout meaning the taxpayers bail the institution out. This bill doesn't do that. Be very clear on that. What it does is says the banks are going to have to ante up over time $50 billion to take care of a bank that fails. So it's a bailout of a bank by the banks as a group, and that's a very different thing and can be used only very special circumstances. With
investors now more confused than ever, are stocks still now the best place to be?
Well, of course they are, yes. And what we I think fail to distinguish, almost a convention now, is that the stock market has something to do with investing. Investing is owning businesses and relying on those businesses and the capital they have at stake to create a return on capital, which is reflected in the dividend yield at the time you buy into the business and the subsequent earnings growth. That is where, in the long run, 100% of the returns of investing come from. So it turns out that all this focus on the stock market is a big distraction. I call it a giant distraction to the business of investing. We spend too much time in these day-to-day fluctuations where in the long run corporate America is going to create value.
Now, there's a growing sentiment that in order to stay competitive and have a solid portfolio, you need to invest outside the United States and look towards emerging markets such as Brazil and China. Do today's investors need to look at those markets, or is there still good growth here in the U.S. of A?
When you get into foreign markets, if you want to buy an international, say an international mutual fund, that is to say a fund invested entirely in foreign stocks, or for that matter in an emerging markets fund investing entirely in the stocks of emerging markets, I don't think that's necessarily an illegitimate choice, but I'm not in favor of doing it in a very substantial way. I would say no more than 20% of your equity fund assets should be in some combination of developed markets and emerging markets, because there's not, there are no guarantees in this world. And so with the U.S. being global, the foreign markets having a whole lot of different kind of risk, including currency risk, like financial stability risk, government risk, regime risk, call it what you will, I don't think we ought to overdo international investing, so-called.
Jack, you've been helping investors for over 50 years, and there's a new edition of your best-selling book, Enough True Measures of Money, Business, and Life, with a foreword written by former President Bill Clinton. As 80 million baby boomers are nearing retirement, what's your best advice for them as someone who's helped so many?
Well, if you haven't accumulated the capital, you've made a big mistake. You should have been saving more during your course of life, but that's all history. And the one thing I would caution anybody nearing retirement is don't reach for more return than the markets will give us. And in the next 10 years, for example, it looks like the bond market will give us around a 4.5% or 5% return, because that's the current coupon rate for corporates and governments together. And you shouldn't expect any more than that. Just keep your costs out of the equation, so you get that as much of that 4.5% or 5% as you can. And as I look at it, corporate America will continue to grow, maybe from these levels a little faster than the American economy, but it's coordinated quite highly with the American economy. But the dividend yield is only about 2%. So I think maybe over the next 10 years, a reasonable expectation, not guaranteed by in any case, a reasonable expectation for stocks might be something like, say, 8% a year.
John Bogle, creator of the world's first index mutual fund and the founder of the Vanguard Group. Jack, once again, it's been my pleasure to have you here on the program today.
Good to be with you, Dan.